but Michaela has a presentation today that I actually think is one of the most important foundation pieces of finance that we really need to understand. There's going to be a fair amount to digest in this through it. This is probably a webinar somebody should listen to a few times to make sure you get the whole of it. But one of the limitations we keep seeing in people that we work with is they often are very focused on one piece of their financials or another, and they don't get a very good holistic view. And what I would really like is for everybody to leave today's meeting with at least a feel for the fact that that holistic view is very important. While the individual financial reports can seem overwhelming at times, what we really need to understand is how they interact, because almost all of us have businesses that can make things like and things like flow. And different businesses sort of had different mixes of the things, but we really have to see all of those pieces together to get a full understanding of the business. So with that, I'm going to turn it over to Michaela. I'm going to shut my mic off so you don't hear restaurant noise. And really looking forward to you guys reacting to what she has. As we've talked about before, interrupt questions. Please don't wait if something really doesn't make sense. And so I'm going to pick on Ashley today. Ashley, if you have questions, there are no beginner questions, so get after it. Don't be shy. And also, just remember, please, we have there are other resources available to you. All of these webinars are recorded and available on our YouTube channel. We also have a podcast that comes out once a week. And don't forget about our other webinar, Thursday, Building Your Business. So look forward to seeing you guys all there. Michaela, I'll let you take it from here. Thank you very much.
Awesome. So like John mentioned, a lot of the topics that we will talk about today have been covered in other webinars. You can find those on our YouTube page. But today we really wanted to focus on connecting all the financial reports, which I actually find to be one of the most exciting topics, specifically because I think connecting the financial reports really helps build understanding. One of my goals today is to present the topics and the ideas in a way that prevents having to memorize definitions and rather lets you see the flow of money through the business. So we're going to be looking at the balance sheet, the profit and loss, and the cash flow, and really looking at it, not just talking about definitions, but trying to visualize how money is moving through the business. So we are covering a lot of ground. But the thing about these connections is we can't really talk about all of the connections unless we talk about all of them at the same time. It was really difficult to figure out how to make it shorter. So we're just going to dive into it and see how far we get. That said, I would love for you to stop and ask questions. There will be a few pop quizzes as we go through. So with that, we will jump in. So we're going to start with the balance sheet, and we're going to start at the very beginning with the idea of starting a brand new business. And I love this quote from Sarah Delavan. We had her on the podcast several months ago, but she said, "Every business starts with debt. It either owes money to the owner, the lender, or both." And this was an aha moment for me. When she said it like that, something just kind of clicked in my brain, and the balance sheet became so much more understandable. And I hope that as we go through this, I hope there's several things that do that for you. Light bulb moments, aha moments, whatever you want to call them. I hope that at least one topic today will help you sort of lock in this understanding and make these financial statements a lot more approachable. So when we think of the business starting with debt, there's a couple different places it could receive funds. The first would be the owner. So when we talk about equity, we're talking about this is money that the owner lent the business. We could also be talking about a traditional lender, which they would contribute funds that we call liabilities. Those have to be repaid to the lender. But the reality is everything that the business starts with is owed to somebody, either the owner or a lender, or both. Now, the next thing a business does once it's fully funded, it gets to allocate those funds into assets. So in some cases, uh, it'll choose to keep cash. Sometimes you're going to buy livestock. Sometimes you'll need equipment or land. But this is how we arrive at this accounting equation. And we see this in textbooks. And in my mind, it was always kind of a little bit abstract until we go back to this really simple quote here. Whatever the business owns and works with, it had to receive funds from somewhere. So this is why the assets always equals liability and equity. That's funding from the bank and funding from the owner. It can't have any assets that didn't start at those two places. So just to go back real quick, the thing that the balance sheet's going to help us measure is how many assets are we managing. We're measuring the assets under management, how they're funded, and then how they're allocated. So funds coming into the business, and then the business manager gets to decide how that funding is allocated. Next, we'll talk about the profit and loss. So the profit and loss is going to measure the value that we create, how much of that value we convert into cash, how much it costs to create the value, and then how much value remains at the end. That's profitability. So we're measuring two different things here. And as we go through the slides today, I hope that, like I said, I don't want you to have to memorize these definitions. I want it to be intuitive. And we're going to go through some visualizations here to help with that. So with the balance sheet, remember we've got funds, our business has started, we've likely bought some sort of assets, whether it was fencing supplies or some equipment, maybe some livestock, but I hope we also have some cash in the bank. And that cash is going to be used to help us pay these operating expenses. We split expenses into two different types. We've got direct cost and overheads. But either way, both are operating expenses. So cash moves from the balance sheet to pay those expenses. Now, as the business is operating, we hope that it's producing value. That could be in the form of livestock, and we're talking specifically about ranches today, but any business would be the same. Whatever product it is or service it is that you produce, you're adding value to something. So in the case of a ranch, we're adding value to our livestock. And then when we convert that into cash, so think of raising calves, then you sell your calves, or maybe adding weight to stockers, and then you sell the stockers. Either way, we're adding value to those calves, and then we're also converting it into cash. Whether it's inventory or cash, it's going to show up in this current assets. Now, this cycle of capital moving from the balance sheet into operations for the P&L, this represents your working capital. So literally capital working through your business. And as you can see, and imagine and most likely have a lot of experience with, this cycle has to keep going. That's why we protect working capital and we talk about working capital a lot, because if the business ever can't afford to pay its operating expenses, like if you have to start pulling back on your direct costs or your overheads, you likely won't be able to produce the same amount of value. So a pullback here could, not all the time, but let's say it's like a forced reduction in costs, would likely reduce the value that you can create. So we don't want to see this cycle slow down. We want to be efficient with our expenses, but we want to be aware of what happens if the business runs out of cash. So in this example, if you're spending less and producing less value, this circle is slowing down over time. So what happens next? The only thing a business can do is get additional funding. And that's either going to come from a lender or owner investment. So this would be just like the very first slide when the business is getting started. This would be an investment by the owner, or the lender could provide current liabilities. And this is how current liabilities gets tied into working capital. In both of these circumstances, we're providing cash, additional cash into the bank account. So if you think of this circle, like this, if this cycle is slowing down because we're running out of cash, this cash infusion to the business could breathe new life into the circle. So just think of the momentum we're creating here. So this is how the balance sheet uses its assets through operations. And we hope that if the business is profitable, it's contributing more value back to the balance sheet. Okay, so I'm going to stop here. Do we have any questions or thoughts so far?
I've got a quick question.
Mm-hmm.
Where would owner investment, so if an existing business, if the owner decided to reinvest capital that they had previously taken away, where would that go back into the statements?
Okay, so you're thinking like an owner might have made an initial contribution, then pulled some out,
Yes. And
taken a
then
loan from the business?
or just an owner draw,
Mm-hmm.
and then down the road decided to reinvest back into the business. Where would that fall? Is that sort of a liability? The business owes that money back to the owner?
So yeah, you could actually just reverse this arrow here. This is visualizing an owner investment. So an owner distribution would just be the opposite. So you would be taking cash out of your bank account and pulling it back to you personally as an owner. So you're just reducing the assets, the current assets, and specifically the cash assets that the business has to use for working capital. You're reducing that, pulling that out, and just taking it out of the business altogether.
Okay, but what if you want to put it back into the business? It just goes into equity?
Yeah, so it actually affects both assets and equity. And this is such an important part, I think. Like, we think it's either assets or equity, but the truth is it's both. And if we, visualize that accounting equation, whenever you put cash on one side, you're infusing cash on one side. The other side has to balance. We know we're not adding liabilities, so what we're adding is equity. And we do have some more slides later that kind of visualize that also. It's a really good question.
Thank you.
Mhm. Any other questions about this process? It'll come up again later, but I know this is so much to digest all at once, but if you think of anything, please feel free to jump in. Okay, so now that we have the business funded, both the initial investment to get started, to buy assets to get started, and then also to make sure that we have enough funds for operations, how do we create and measure value? This is where we're going to focus on the profit and loss statement, and we're going to start with gross product. So the definition, and I'm not going to ask you to memorize this, remember, we're not, but the definition is gross product is measuring how much value you create. So this line here, when we look at the P&L, the gross product, that's what we're measuring. That's what it's telling us is how much value you're creating. And I think spreading it out over this timeline, looking at it month by month, is really helpful to see how it does this. So we're starting with a very simple example, custom grazing. When a custom grazer adds value or creates value in their business, they're converting forage to gains in the cattle or care for the cattle. So they're providing a service, and very quickly they will invoice and receive funds for that. So they're creating value and converting it into cash very quickly and very regularly. So that's where we see for the months of April through October, we see consistent revenue. This is a very simplified example, but let's just say they make $10,000 a month for April through October. This represents both value creation and cash conversion because, like we say, they're grazing for that month. They almost immediately get cash for that, and the cash flows back to the bank account on the balance sheet. So any expenses they have, which would be little for a custom grazer, usually there's very little expense in the terms or in the way of direct cost, but also any overheads would be paid using cash out of the balance sheet, but they very regularly produce cash that goes back to the balance sheet. So typically, custom grazing provides good working capital. There's good liquidity in that operation. Now we're going to consider what it looks like for a slightly different type of operation. If we look at a cow-calf producer and ask how can this gross product measure the value creation, we see that there's actually no revenue until we get to December. So instead, this time we're looking at inventory change. And specifically here in October, we see our first transaction. This is where we're adding weaned calves to our livestock inventory. So in October, we wean our calves, we count them, we weigh them, maybe we vaccinate them. This all happens in October, and that's when those calves hit the balance sheet. So if you can envision the balance sheet on one side, it has a new inventory for calves. At the same time, on the P&L, we're capturing that inventory change. So the gross product for that month is $100,000. Now in November, we're carrying that inventory forward. We haven't sold it yet, but they stopped balling. They have gained a little weight. We're just lining them out. So they're adding value here. That backgrounding before we sell them, let's just say, adds $15,000 worth of value. We see that right here in the gross product. So now we've got 2 months here that capture value creation. The third month, or December, I should say the 12th month, is where we actually see the cash conversion. So this is where we exchange our livestock inventory for cash. But check out the gross product here. In this example, let's say we are selling on December 1st. So we've backgrounded our calves for, say, 60 days, 45 to 60 days, and we're selling on December 1st. In December, we haven't actually added any value to the calves. We haven't created any value in December. We're simply converting it from inventory to revenue or to cash. So if we compared this to our balance sheet, in October, both our assets and our equity would get a $100,000 jump. In November, we would see an additional $15,000. In December, there actually wouldn't be any increase in assets or equity. Rather, we would see a reallocation. We're just exchanging our livestock inventory for cash. And typically, we end up looking at the total. So we lose this view here. If we just look at the total and see $115,000, we lose the story, right? So this is where it can be really helpful to look at your P&L month by month and see when are you creating that value? And then the other thing you can see here in the totals is even though we have these transactions here that capture the value month by month, the total here is zero. $0 change, that is. And that's because our inventory increased and then it decreased, meaning we sold all of the inventory of calves that we had captured here and converted it to cash. So now we see that value here. So it's a very almost like three-dimensional way of seeing the value that you create. So I want to pause here. We've got one more example to go through, but are there any questions so far?
I might not understand this right, but
Mhm.
you're actually saying you're selling the calves in December. What if that value is more or less than what you projected it to be at inventory? And
Great question. Yeah, so this is a very simplified version, but let's say you sold them for $130,000. What that would mean, it could mean two things. One, it could mean that you still added some value in December, but it could also mean that maybe you were a bit conservative in your inventory values. Maybe you just got a better price than you were expecting. If that's the case, usually you're not going to be too far off, and the total will still be 100% accurate. But in the case of being a slightly conservative or a little bit off in your inventory values, December is where you would see that true up whenever you actually sell them and convert it into revenue. So ideally, we want this to be as close to zero as possible when it's a true cash conversion event.
okay, thank you.
But we recognize the fact that every number prior to the actual sale is an estimate.
Mhm.
And then at the end, there's the true up. Hang on, Aaron's got a question too. Can you hear him?
Why do we need it to be zero, Michaela? Because it's going to get reconciled over on the P&L.
You're right. So in the total, it will all come together and say the same picture. But like, let's think through if, like, let's say we estimated inventory to be 115,000, but we only sell them for 100,000. What that would mean is we were giving additional credit to the months that came before. So we overvalued our inventory in October. Maybe we overvalued it in November. So we're giving October and November additional credit beyond what was really produced. So in the total won't change. So if you're just looking at 12 months, like a certain time period that represents whatever production cycle you're looking at, that's totally fine. But if you are going to look at it month by month and try to determine when you're creating that value or when that value is being created, it's helpful to be as consistent as possible.
And to add to that, if you're using a November P&L to make decisions about that following year, you want those estimates to be as accurate as possible, right? Because
So
in
it's
theory,
not,
those are going to determine the performance of those enterprises and may impact your enterprise mix or your enterprise allocation.
yeah, that's a good point. Anytime you're,
The difference between the two would almost seem to be a marketing opportunity. Lack of opportunity as well.
Ah, good. Okay, so I don't know if you heard that, but Aaron said the difference may be a marketing opportunity or lack of opportunity, and I would agree with that. That marketing can
yes,
have a huge impact on the final. Yes, good
that's
point.
right.
Yeah.
That's right. So I think maybe I should rephrase that to say, we would like for this to be zero or more than we were expecting. We would prefer that when you create or when you sell those, that you're not getting less than what you were expecting or
But
projecting.
whether you're high or low, it will correct in the end. Eventually everything goes through the bank account or
That's right.
doesn't. Yeah.
Right. Yeah. Good question. All right. Are we ready for one more example? This is the first pop quiz. So take a look at these numbers. This is going to be our more complex example. We've got another line added here. We've got purchases along with the inventory change and the revenue. Still broke out over the same number of months. But what does this gross product tell you? Is there anything standing out to you? Y'all can just shout it out.
The work of the business added $90,000 worth of value in the course of 12 months, in the months that we're looking at.
Very nice. Yes. Anything else jumping out?
I just see they bought cattle and they made them better every month until they had the sale, and then they captured the $90,000 of value that they created.
Very well said. So every month we added value. This is a very consistent operator. $15,000 worth of value every month. And then we had that cash conversion, just like you said, where we captured that value, that 90,000. So
They
let's
did a good job of valuing their stuff.
yes, they did. Came out to 0. It's nice when you can just make up the numbers you want to see. Okay, so let's see if I can figure out how to advance this thing. Okay, here we go. So here's exactly what you said, the value creation. We see that over time. So this $200,000 is where the stockers would show up on the balance sheet in April. In May through October, every month, the stockers gained $15,000 worth of value. And then in November, we see this is when the value would fall off the balance sheet completely. And yes, Eileen, you're right. They made $90,000 total value for the year. So if we want to highlight the cash conversion points, we've got 2. The first is converting $200,000 worth of cash into $200,000 worth of stockers. So on our balance sheet, we don't actually see any change in assets, total assets, or equity. What we see is a reallocation, just exchanging cash for stockers. Then on the other side, it's the same thing, but opposite. So we're exchanging stockers for cash. But the interesting thing is our balance sheet grew all along the way. So this $15,000, this gain that's highlighted down here, that gross product is telling us we're gaining $15,000 a month. This is where the balance sheet went up. This is just a cash conversion. Okay, pop quiz number 2. Why is our gross product 0 in April if our inventory went up by $200,000?
You haven't created anything yet.
Very good. Perfect answer. So our gross product is 0 because we purchased $200,000 worth of value rather than creating it. So gross product, it sometimes I just feel like it's like magically telling you how much value you're creating. And this is a perfect example. It's not magic, it's math, but I get excited. This is value that you purchase and then you begin adding value to it, right? So we want to make sure that we're not trying to claim the whole $200,000 worth of value here at the end. We did not create $290,000 worth of value. So once we take out the value that we purchased, what we're left with is the $90,000 we created. Perfect. Okay, any questions about gross product? Any thoughts or aha moments here?
I do have a question. So were you Where you're using your creating value of the 15,000, is that like your feed that you're putting into those animals to gain weight? Is that what that is?
So you're setting me up perfect for a segue here.
Oh,
I'm
good.
just going to go to the next slide, and I think it's going to help answer your question. Okay, so we talked in the beginning about the P&L helps us measure the value we're creating. So I just moved these numbers up, but here's your gross product. This is the value that you created. Here's your 15,000. And then here's just some really random number examples of direct cost. This could be some feed, maybe a little vet or medicine expense. Then your overheads would be down here. So today we're not getting into overheads versus direct cost. We're just recognizing that all of these expenses, this is the cash that's leaving the business. So I'm going to go forward one more slide. If we remember this little graphic at the beginning, we've got the balance sheet and the profit and loss statement. This pink is the cash that is being spent on direct costs and overheads, and it's represented here. This is where you would buy the feed. You're putting that money into the cattle. You're writing a check for that. It's leaving your checking account, but it's not wasted, right? It's being fed to the animals. The animals are gaining value. So this is where you're being a good manager. You're making sure that the value of gain is more than the cost. Thank you for the question. Are there any other thoughts there? Oh, I can't hear you.
You're muted, Heidi.
I said that actually makes perfect sense.
Wonderful.
Thank
I have a question.
Yeah.
Okay, so on your gross product where you're getting the 15,000 and
Mm-hmm.
on your net income where you have the 8,000.
Mm-hmm.
So is that because basically you're showing what you spent to get that value of gain of the 15,000? Am I following that correctly or no?
Yes, and y'all are just helping me so much. We're going to go right to the next slide. This is exactly what you're saying.
Okay.
Here's the value you're creating on the gross product. Then we've got the expenses, the cost that it took to create the value, and what's left is net income. So if we're thinking, what is net income? What does it mean? It's literally an increase in assets beyond the cost of creating that value. So here, when we say assets, we're literally talking about our stock or inventory. Our stock or inventory is increasing $15,000. We can see that in the assets section on our balance sheet. We know it took us $7,000 to create that value. So our net income for May is $8,000. Our assets increased $8,000 more than what we spent. And month to month, some businesses find this to be useful month to month. Most businesses are going to be using this as a total. So if we look at the total and we say we produced $90,000 worth of value in our stockers, and it cost us $42,000 to do that, our net income is $48,000. And we know that we've already converted this inventory to cash. So we know that this $48,000 is it's an increase in cash in our bank account. Now, alternatively, let's say we hadn't converted it into cash yet. Let's just say that at the end of the year, our inventory was $290,000. We would still have added $90,000 worth of value to the calves, and our net income would still be $48,000. but the asset represented on our balance sheet would be stockers. We would have less cash, more stockers. Okay, so there's a lot going on this slide. We're going to kind of change gears in just a minute, or I guess I could go to the next slide. The next slide's still kind of in the same vein here. So we've looked at this circle quite a bit here. The current assets are the cash going into operations, and then the operation sending value back to the balance sheet. What that means is anything left over at the end, the net income, is increasing your total assets, whether that's cash or inventory. So then the next question is where we're going to go next. If we increase assets, and we remember that accounting equation that we looked at the beginning, we know that assets has to equal liabilities and equity. So if we increase our assets and we don't increase our debt, what we're increasing is our equity. So net income is going to increase both your assets and your equity dollar for dollar. Now, I think Josh, I think it was you that talked about taking money out of the business. That could still reduce your equity. But if we're just
The translation is through retained earnings, right, as a percentage of the total.
right. Okay. So do we
Hang
need,
on one sec, Michaela. Does that need more clarification?
well, I think we'll get to it in the next few slides.
Okay. Very good.
Does anybody have any questions about the P&L, how it creates value or how it measures this value that we're creating, the conversion to cash, how much it costs to produce, and then profitability? We're going to really drive it home in the next few slides, so I want to make sure we get this part right. Okay. So we've talked about profitability, creating value. Now we're going to visualize where that falls on the balance sheet. So we have the balance sheet represented here by this graphic, literally a balance. This is where the balance sheet gets its name because we've got assets on one side and liabilities here in the blue, current liabilities and long-term liabilities, and then equity. When we combine these together, these things have to balance. So here we've got $300,000 in assets. We've got $300,000 in liabilities and equity. So pop quiz number 3. This is the last one. Can anybody tell me how much equity we have in this business? I'm sorry if the numbers are small.
150,000.
Exactly, 150,000. And we're going to use this same, I'm not changing this structure as we go forward in these slides. So we're going to be talking about how to change the business, but this is where we're starting. All right.
I have a question.
Yeah.
This is probably gonna be dumb. What is a fixed asset?
Okay.
Give me an example, please.
Good question. So a fixed asset is something that you can use over time. It's going to continue to hold its value over time, add value to your operation over time. So this would be something like a cow-calf herd, breeding stock, or any breeding stock. It doesn't have to be cows. Equipment or land are the most common fixed assets we see.
And then what would be a current asset?
Current assets are anything that's going to turn over in the next 12 months. But that's kind of the textbook definition. So if you think of cash, also anything like accounts receivable, that money that you're going to be getting in. Also calves or market livestock, anything that you'll be selling in the next 12 months.
Okay.
And let's add one more quick clarification on that, Michaela, because we generally don't recognize what are called intermediate assets. we break the world into 12 months or less, or 12 months or more. And a lot of lenders have a class they call intermediate assets. Those would be things that are financed on a 2 to 5 or 2 to 7 year schedule. So tractors, trucks, those sorts of things would be on cows, right, would be on an intermediate schedule, whereas real estate would be on a long-term schedule. I don't see the distinction being important. Some lenders do.
That's right. That's right. And yeah, honestly, I even forget they exist because, it's just it's very quick and clear if you think of your current assets as what you can turn over and use in your operation to keep it running. Fixed assets are basically everything else. And then same thing with current liabilities and long-term liabilities. Your current liabilities are the things like accounts payable. So if you use any financing terms with the co-op, for example, they might bill you and it's due in 30 days. Also, credit cards or lines of credit, those are expected to be paid within the next 12 months. Long-term liabilities have an annual payment. So they're paid, over an extended period of time. It could be 2 years, it could be 30 years. But that's the difference between current and long-term liabilities. And then equity is what the owner owns in the business. So what is the owner's? Technically, it's what the business owes the owner. So if the business was sold, that would be the owner's portion of it. But we don't distinguish, there's no breakdown in equity really. So are there any other questions about that? That's a really good one to start with before we go to the next slide.
Michaela, we had a question in the chat. Should we be doing a P&L for each enterprise?
It's a great question. It's really helpful to do that, especially if you want to analyze which enterprise is creating value and which ones are creating value most efficiently. It just gives you that kind of three-dimensional look into your business rather than just saying this is what happened after 12 months of working. You can see which enterprises are helping you the most and also which enterprises need more attention. Are there any follow-up questions to that or anything specific?
No,
Michaela, I want to, oh, go ahead, sorry.
No, I just, I guess right now we just have everything on a business P&L.
Mm-hmm.
Just want to clarify that I should be breaking that out to different enterprises.
It does add a layer of complexity, but I think it's often worth it.
Real quick, Michaela, the peanut gallery I'm seating with wanted to make sure that we understood that when we talk about fixed assets, we are categorizing types of assets. We are not necessarily saying that they can't be sold or shouldn't be sold. It's more of a traditional accounting term there. So fixed assets are long, you could own a long-term asset for less than a year. We still call it a long-term asset. We still finance it like it's a long-term asset, but it doesn't necessarily mean that we're locked into that.
Yes, and maybe a better way of thinking of it is like how long they hold value. Like you said, when we compare it to the types of debt that we use to finance those assets, I'm specifically talking about like liabilities here. You could use a cow who's going to hold her value for several years to get a long-term note, but a lender's not going to lend on a calf unless it's like a heifer that you intend to breed and have for a while. So it's really how long they're going to hold their value, I would say, is a better definition. That's a good point from the peanut gallery. Okay, we will keep going. So the first question here is, how does a business grow? I think this is a goal that a lot of people have. And what does that even mean? And I think under most circumstances, it's safe to really boil this down to mean, how does a business increase its assets? So if you're growing, the goal is to increase the assets that you're managing so you can grow your net income. And we're going to start with what we ended with on the P&L. Net income, when it's retained over time in the business, goes into this bucket called retained earnings. Or said another way, retained earnings is your accumulated net income for the time that you've been in business. So when you add value, let's say in this business that we're looking at here, represented by this scale, let's say we've got $100,000 in retained earnings. That could be split multiple different ways here, but in this example, we're saying that we've grown our cash by 50,000 and we've increased our herd value by 50,000. The really important thing to see here is that it balances. We've got 400,000 in assets. We've got 400,000 in liabilities and equity. So we're balancing, and because we added this through retained earnings, we're increasing equity. All right, so, okay, I lied. Here's another pop quiz. What are some other ways that a business could increase its assets? If you want to grow, what's another way you might do it?
By adding liabilities.
Very good. Very good. So here we're showing an increase in liabilities. We're going to purchase an increase in assets. We're going to purchase 100 cows and add $100,000. I said 100 cows. $100,000 would not get us 100 cows today. But we're going to say add $100,000 worth of cows to our balance sheet here, increasing our fixed assets to 300,000 and our total assets to 400,000. And we're doing that by adding a liability. So again, the balance has to balance. In this case, if you want to buy more assets, you could use additional liabilities. And then there's one more way to add assets. Can anybody think of it?
Does land appreciation play into this?
Elaine, coming in with the hard question. Yeah, I think it could. I did not have that as an example, so we'll call that a fourth way. But if you increased your fixed assets by having land appreciation, that would show up as equity over here. And, we'll just proceed here with this next example because it does kind of illustrate that point. Again, anytime you increase assets without touching your liabilities, you're increasing equity. And in this example, like Josh was referencing earlier, if you've got owner investment, meaning you're putting personal money into the business, you can use that to grow your assets. So here we're saying let's put $50,000 in personal savings into the business so we can purchase $50,000 worth of cows. Now, I have in the parentheses here that we're limited by what the owner can afford. That's often the case, not always the case, but usually there is a limit to what the owner can put into the business. And that's why it's often easier to grow the business with debt, like we saw here. And that's also why debt is called leverage, right? We can leverage or use the lender's money to create a lever for us, purchasing more assets than we could purchase otherwise. Any questions about this, growing a business's assets?
I'm a little confused on when you basically took out a loan to purchase cows and that balanced. How did that balance when technically you took out that loan and now you got to pay interest on that?
That's a good question.
That is a good question. Okay. So interest, I just want to make sure we've got another slide that's going to help with this. So I just want to make sure I'm not getting ahead of myself. But when you take out a new loan, we're not going to include the interest that you will pay in the future on the balance sheet. So the liability is represented by the actual dollars that you used from the lender, but you're 100% right that over time it will take interest. It will cost interest as you're making those payments, right? So the reason we don't include interest when we put it on the balance sheet to begin with is because we don't know exactly how you'll pay that back. It could change over time.
And so if you were to pay off your debt
Mm-hmm.
flat out, then now you don't have any liabilities. You just have more equity on that side.
You just keep setting me up. We're just going to go right on to this next slide. So how does equity grow? So now we're changing from how does a business grow its assets to how does a business grow its equity? And your question there is perfect. How does paying down debt affect equity? Would anybody like to guess? This was a big aha moment for me when it hit me. If we use, let's say, $50,000 cash to pay down our debt, and we're just going to make it really simple. This does not include interest. We're going to say we're using $50,000 cash to make a $50,000 principal payment. It does reduce our long-term liabilities by $50,000, but we've also reduced our assets, our cash, by $50,000.
Equity does not grow.
This is Thane's concept right here.
Yeah.
Living through
So,
the oil guy.
in this example with a principal payment, using cash to pay debt or to pay down debt, so we're talking specifically about principal, it reduces both assets and liabilities at the same rate. But since you're thinking about interest, we could clarify here that let's say a portion of this, let's say this is a regular payment and maybe $20,000 goes to interest and $30,000 goes to principal. Then our assets are going down $50,000. We're using $50,000 cash. Our principal only goes down $30,000. So where does the other $20,000 go?
We sell by the wrong way.
It's going to come from our equity. So,
And Michaela, let's clarify that because we had a question Tuesday on our financial Q&A about this. Remember, interest, we report interest at the bottom of your P&L. And so interest is an expense, the principal payment is not. And it's very important that we understand the difference between those two things. So interest is an expense to the business, shows up on the profit and loss. Principal is a liability to the business, shows up on the balance sheet. And so effectively that $50,000 payment you just mentioned, 20,000 of it shows up on the P&L and leaves the business.
right.
And 30,000 of it reduces the liability on the balance sheet. And 50,000 comes out of the asset on the balance sheet.
That's right. So it's a tricky, and I don't want to say, let me clarify. I am 100% advocating for making all of your payments. Please make your payments. But the choice to pay down extra, we just want to be really clear about what that does for us. And paying extra on your debt, we just want to be clear that it does reduce our cash at the same or even more than we put on that we take out. So that was really confusing. But the principal payment, if we use $50,000, it may not even reduce the liabilities by that same amount if we pay interest first. So I think we can keep going, and I think there's in a few slides this will help too. So I'm just going to go ahead and cross this off. If we're asking how does equity grow, it's not paying down debt.
Hey, you stupid dog.
On the next way that we could have equity grow,
Hey,
this is
go
kind
get
of
your
a
own food.
technicality, but I wanted to just address this as a possibility. If you are looking to grow your equity or grow your assets, you can use owner investment here, the same example we used before, where you put $50,000 of personal savings in the business. Technically, this does increase your equity, but it actually just transfers personal equity into the business. So you'll see equity grow on your business balance sheet. But if you were looking at a consolidated balance sheet for your personal life, there would be no change in personal equity. And then this is where I wanted to get back to with the idea of interest. Again, the retained earnings is your cumulative net income over the time of your business. So interest would be one of those business expenses that reduces net income. So if we had this $50,000 payment that we took out of cash and paid $30,000 down on the long-term liabilities, this retained earnings would be decreased by $20,000. So we're actually affecting both long-term liabilities and equity.
And can you
Now,
explain where you got the retained earnings again? What is that? Where did that come from?
yes. So when we looked at the P&L, we got to the bottom, the net income, and we said we added $48,000 to our business assets. So that was net income that goes to the balance sheet and adds to the retained earnings bucket. Every year, we put our net income into the retained earnings bucket and we keep going. This would be like a follow-up example. So in this business, we're looking at the balance sheet now. So in this business, over time, from the time that it started until today, it's produced $100,000 of retained earnings, literally just profit that's been retained in the business.
So basically, when you made that profit, you didn't basically, I guess, pay yourself for anything. It all went back into the business to grow the business.
So I'm just going to sharpen this a little bit. Let's say that you did pay yourself, but it came out of the P&L in term as wages, as an overhead. So you paid yourself, but then you still had that net income at the bottom. That went to the balance sheet and you didn't take it out. So some people take it out for land payments. Some people take it out to remodel their house. Some people take it out just because they can. There's a whole variety of reasons you might want to. But in this example, we're saying that you kept $100,000 worth of earnings or net income in the business.
So,
Go
go ahead.
Oh, I was just saying, wouldn't this, so normally you have to pay taxes on cash or inventory when it's a personal, like on your personal taxes, but if you run a multi LLC and you keep the cash in the business, it's not taxable until you draw it out. Is that correct? So it would make sense. Am I understanding that correct?
Well, so I think I don't want to speak too much to taxes. I am not a tax accountant by any means. But I think in general, when you keep the cash in the business, as long as you're still invested, if you're buying assets, the tax code generally rewards that by not making you pay tax on that. So that is a function of our tax system. It rewards business investment, keeping money in the business.
And let's clarify that even a little further. If you keep it in the business as cash, generally you will be taxed on it. If you use that cash to buy cattle, for example, you are not.
So when I say investing, I mean that literally, like actually being invested in something, cattle, or it doesn't have to be cattle, of course, it could be other things, but just taking the cash and letting it sit there is not going to save you on taxes.
Okay, so if we sold some calves and we use some of that cash from the calves that we sold and we turn around and we paid for a class to make us more knowledgeable in how to market our cattle, that would be an expense or that would be reinvesting it in the business?
What a good question. So technically, the IRS considers that an expense.
Okay.
But you're right. I think most of us on this call would consider that an investment. So what we're saying is we're investing in our future and our knowledge. It's an investment in ourselves, but the IRS would consider that an expense and allow that as a deduction.
So would that be in that retained earning bucket or no? Or am I
No,
not?
it would be an expense, which would reduce your net income and your retained earnings. But we
Okay.
hope that the knowledge you gain there is going to allow you to go back to your operation and increase your profitability in future years,
Okay.
which does add retained earnings and does add assets.
Okay.
All right, so there's one more piece here. We're going to make this a little bit more specific yet. So now we're asking not just how does equity grow, but how does equity compound? And I think we can very safely cross owner investment off the list. There's only, there's going to be a limit, at least for most of us, there's a limit to how much we can invest in our business. We want this to be a sustainable, sufficient business. So we're going to cross owner investment off the list and we're going to focus on the retained earnings piece. And specifically, just like you're saying, we want to use the profitability that we make to invest in assets that are going to increase future profitability. So that's the beauty of this system. You're creating more assets, and then you get to reallocate those into income producing assets that create more profitability in the future. Okay, so I'm getting a little ahead of myself. Just real quickly here, we're coming to the end, but I want to emphasize two important jobs. So every business manager, job number one is going to be to create profitability, to create value beyond the cost of creating it. That's where we want to see this retained earnings on our balance sheet increasing. We measure that on the income statement or the profit and loss statement, and then it adds assets to the balance sheet in the form of cash or inventory. Now, job number two. We need to deploy the value that we create, the profitability that we earn. We need to deploy that in a way that serves the owner's goals. So here we have retained earnings. We're going to say that we've locked in that profitability. Now we're going to focus on asset allocation. So number one, you could keep cash. Now we just talked about there's some nuance there about taxes. I'm just going to leave taxes out of the discussion for now, but you could use that cash to keep your operation running. And, we need the operation to keep operating if we're going to keep making profit. So that is one good use of profit. Another good use is to buy assets that increase future profitability. So using that profitability that we created, that cash, to buy income producing assets. And we've already talked about that's how we can make equity compound in the future. We could also pay down debt. So let's just talk about principal payment only. We're just making an example here that we're going to make a principal payment, pay down the long-term principal that we have, and we're going to see that decreases our assets and decreases the other side, right? We're reducing the liabilities. So while this does not increase future earning potential, it does reduce our exposure to risk, which is a valid goal. So depending on who the owner is, their financial situation, their preference for debt or not, I just don't want to make it seem like buying assets is the only answer here, because paying down debt could work for some people. We just want to make sure that we're recognizing the trade-off, right? And then the very last way that I could think of, at least, to deploy this would be as an owner distribution. So if we're not buying assets or keeping cash, buying assets, paying down debt, the last thing would be an owner distribution, which again does not increase future earning potential, but does contribute to the lifestyle of the owner. All right, I know we're over time here, so I'm gonna, unless there's any questions, I'm gonna keep going. So we've talked about the profit and loss and the balance sheet. Just real quickly, I think it's kind of fun to get to this point where we're looking at the cash flow statement. The only real aha moment we have here is to realize that the cash flow statement actually tells us nothing new. It just gets all of its information from the profit and loss and the balance sheet and presents it in a more understandable and readable story. So specifically, it's telling us how much cash did we use in operations? Did we send from the balance sheet, our cash account, into operations? And how much cash did we get back? How much cash was allocated to other assets, like fixed assets, whether that's livestock, or it doesn't have to be fixed assets. It could be market livestock or equipment or land or anything else that we might buy with our as an asset. And then the last thing it tells us is how much was allocated to repay lenders or business owners. And it can actually go both ways. You can get more money from lenders, cash from lenders, or cash from business owners with an owner investment. Same thing with cash allocated. You might be spending cash to buy assets, or you might be selling assets to get cash. It works both ways there. And the beautiful thing about the cash flow is it captures all of that cash movement in one place. So you don't have to investigate both the P&L and the balance sheet. You can pull up one report, the cash flow, and it gives you a summary of everything that happened for cash movement.
Michaela, when you're talking a minute ago about paying the debt or keeping any cash, both were valid options. Is it fair to say the difference is your risk tolerance?
Yes, and your preference for debt. Probably also the details of the loan. Maybe you just got one payment left and you want to be done with it. That would create more cash flow in the future, that sort of thing. Maybe you've got a high interest rate that's really bothering you. There's details there that could incentivize you to pay that loan down. But I like the way you said that they're contrasting keeping cash versus paying it down. And we have some other webinars on risk, financial risk, and we specifically talked there about if you reduce your cash, you can't really get it back. If you make that loan payment, it would be difficult to go get that cash back. If you have the cash, you can always make the payment.
Comes down to working capital too.
Correct.
Yeah.
Yeah, and Aaron makes a good point here, which is if you're paying down long-term debt, you are taking a short-term asset, cash, and reducing a long-term liability. And so you are probably making your working capital worse, even though you are reducing the principal on your term debt. So we want to be very careful how we do that.
That's right. Cash is kind of the ace. It is the ace. There's multiple ways to play it. It's the thing that keeps you in the game. So I would want to have a very good reason for paying down long-term debt or, making extra payments on that long-term debt. Okay, so just a few questions here. Have you ever been profitable and broke because you were shoveling all of your cash into buying more livestock?
I've been broke and broke.
So I think we've got a lot of customers that would identify with that, Aaron, broke and also profitable and broke. But the cash flow, the cash flow can help us understand that we're not, maybe our P&L looks really good, but we feel broke. Our balance sheet, our bank account feels broke. And that's because we're shoveling all of our cash into buying more inventory. Have you ever had to destock and wondered how long your big pile of cash will cover your overheads? So if you've ever had to destock, you might, your bank account might look great, but you have no way of creating value because you've had to destock. So your overheads are going to eat into your profitability there. So both of these things, I would say most ranches have probably felt both of these things at some point in time. The cash flow statement can help you navigate, what's happening. Why are you feeling the way you're feeling? So the cash flow statement really just combines both the profit and loss and the balance sheet. You can see all the information is going from those two reports to the third report, and it just tells you the story of how cash is moving into your business when it's initially funded, when it needs more funds, through your business as it works through operations, and then out of your business when it's time to, both pay expenses and also pay back the ones who are funding the business, whether that's a lender or an owner, either way. So this is my last slide. With a manager can and should use the entire team of reports to help them accomplish their jobs. So specifically, we're using the profit and loss statement here to help us with our first job of maintaining and increasing profitability. We use the balance sheet to help us understand how much or what assets do we have under management and how are they allocated? And are we allocating them to best serve the owner? And then the cash flow statement really just tells the story of how we've done on these and what we have to work with going forward in terms of cash. So all three reports are critically important, extremely connected, and when you pull the thread on one, it's so fun to see how it connects through all the reports and how you can use that to make management decisions. So do we have any questions? Is there any slides you'd like to go back to?
How do we rewatch this again?
We're going to have it on YouTube. We'll have a recording that we've recorded today, and we'll upload that to YouTube. So yeah, you're welcome to watch it again there. You're also welcome to just send us some questions. My name is spelled kind of funny. It's Micayla. But you can email me, Michaela@ranchrightllc.com.
And I believe, Michaela, your contact info is on the website. Is that right?
Yes.
Okay. And if you can't find that, the office email is there. If you send an email for Michaela to the office, Kylan will get it to her.
That's right.
And these videos are also available on our ranchrightllc.com website. They're just links to the YouTube, but you can find them there also. And for any of you that don't know, we also do a financial Q&A every week on the ranching.fyi forum. So if you have more questions about this, we can certainly talk about that there. Okay, any other questions or thoughts? Michaela, this is an awesome presentation. Thank you.
Great job.
I really appreciate you putting this together. This is the most comprehensive look I've seen that to me really incorporates all of the things that we as a team at Ranch Right understand and try to help people see. And you've done a really nice job of sort of portraying that. Thank you.
Thank that girl for questions.
Thank you.
It was a lot of fun to put it together.
Good. And definitely thanks to all of you for questions. So Ashley, Josh, all of you that asked questions, Sean, thank you very much. Those make the discussion much better and help us refine our presentation and understand what we need to talk more about.
Absolutely.
Awesome. If there aren't any more questions, then let's wrap up. Check out the website, check out the YouTube channel, come listen to the podcast, like and subscribe in all of those places. And we will be back on the third Thursday of the month with another financial foundations webinar, first Thursday of the month for building a better business. So look forward to seeing you there. Thank you all for coming. Really appreciate it.
I'm recommending a board member get to one of your sim events. Would that help them with drought planning?